It's ironic, isn't it? I'm the only one on the panel who doesn't have a tie. I don't know what that says, but maybe this is progress. You know, when I'm in London and I present, and I present without this, I say to the bankers in the audience, maybe this is what you call innovation, not wearing a tie to a conference. But sorry, guys, I'm not suggesting in any way that this correlates with a lack of innovation either, by the way. But so today, when I was asked to present to the group here in Ukraine, I thought, you know, the Ukrainian market and the Russian market, I know some of you are from Russia, is a little different to the West. We don't have the check problem, but we have the cash problem. And so when you start talking about the changes that are happening in the market, many people feel like it's different here. But I've spent a lot of time in different markets in my career. I spent 7 years in Hong Kong. I spent 5 years in the Middle East, in Dubai. I'm now living in New York. And every market tells me the same thing. We're different. It's different here. But there are some things that we have in common. And that is our use of technology in recent times, particularly the smartphone. You know, smartphone growth around the world is just incredible. I don't know whether you are familiar with Mary Meeker. I'm sure, George, you follow her reports, but she just released some data last week that shows smartphone adoption went from 1 billion in 2011, 1 billion people with smartphones, to 1.5 billion last year in 2012. 50% growth in smartphones. And by the end of this decade, 80% of the world's population will have a smartphone with internet access. And this is something that we never had before. So while we had branches before, while we had the internet before, we didn't have a personal device that gave us this level of interaction and control. So this is a game changer. This is something that's going to change every market. But this is the question I thought I would pose today. Will the bank disappear? Not branches. Will the bank disappear? So let's talk about this question. Let's start with this. This is a typical scene that we might think of as banking. Now, obviously, this is an older scene, olden day scene. But banking, particularly in branches, hasn't really changed that much in the last 200 years. You go to the bank. Now, we even call it going to the bank. We think of going down to a physical place. So it's understandable that most bankers feel very comfortable delivering their banking services like this, because this is the way they've always done it. So if we say to a customer, we want you to come down the branch, you have to sign a piece of paper, or you need to come and talk to one of us. This is our instinct as bankers today. But this is not necessarily great service for customers, because today, when a customer pulls out their smartphone and they know they can do something on their phone that they shouldn't need to do in the branch, and if you force me into the branch to do that, then customers don't think of that as great service. They think of that as bad service. If I know you have the capability to do this on a phone, but you force me into the branch to sign a piece of paper, it's just bad service. So this is one of the challenges. So much of what we do in banking is this process that we have developed over decades, and we're used to it as bankers. We think it's less risky if we open a bank account when a customer comes into the branch and we can see them face to face. This is better for us as bankers. Is it better for customers? Well, they can open a Facebook account on their phone. They can open a Google account on their phone. They can open an iTunes account on their phone. Why can't they open a bank account on their phone? Oh, banking is different. But why? You know, this concept that IDV, or identification, verification of an identity, is safer in a branch, is one thing we're really going to have to fix in the near term. Now, this generation has grown up visiting bank branches and being very comfortable with it. And for most of us, this is the generation we would identify with. Now, if you want to buy some new clothes, your instinct probably is to go down the street, go down to the shopping mall, and try out the clothes, stand in front of the mirror, because this is the world that we grew up in. Tangible. We needed to touch and feel the product. We talk about this trust element. I know in Kiev, in Ukraine, we talk about trust as being a really critical issue with the banking sector, because the banks have struggled over the last few decades with the financial crisis and other issues. During the 80s with perestroika, the issues with the banking community. And so people feel like it has to be real. I have to be able to see this bank. If I can't see the bank on the corner, how do I know they're real? This has been our generation's psychology. Because if you have a problem with your bank account, you can always go to a bank somewhere near you and yell at the banker till they give you your money. This is maybe the psychology behind this. But as a result, we want to get people into the branch to talk. This is how we want to talk with them. This is how we think of a relationship in the banking space. But this is changing. Our customers today, even though we try and build better spaces, better places to talk, they're not visiting bank branches as much as they used to do 5, 10, 20 years ago. And we've seen this in other industries. Most recently, the books industry and the music business. 10 years ago, our instinct was to go down the street to buy a physical CD, a vinyl record or a music album in a plastic case. This was our instinct. Now we can download from iTunes or other sites, we can download this music onto our phone. Our instinct has changed. And how many music stores survive today? Now, this doesn't mean every physical music store disappears. Not every branch is going to disappear. This is not the death of branches, but our instinct will change. So we start talking to our friends now about our needs, about which banks that we like, what products that they like, how you would recommend one service business over another service business. Our interactions have changed. And also the amount of information available, the way we decide on things. There's so much content available today. It's like trying to take a drink from a fire hydrant. So much data. Let me illustrate it in this way. From the dawn of mankind until 2003, it's estimated that mankind as a whole generated 5 exabytes of content. Now, maybe you don't know what an exabyte is. Let me explain. You know a gigabyte, right? We have memory on our phones, normally 32 gigabyte or 64 gigabyte memory on our mobile phone. Or on our laptop, maybe you have 500 gigabytes. So this is a measure of memory. So you have gigabytes, then you have terabytes, then you have petabytes, then you have exabytes. So this is a lot of content. Now, from the dawn of man until 2003, it's estimated that mankind generated 5 exabytes of content. Today, we generate that same amount of content every 2 or 3 days. On the internet today, 90% of the content that exists on the internet today was generated in the last 2 years. This is a dramatic difference that we haven't had before. Now, advice, giving special advice as a banker depends not only on a space, but the fact that the banker knows something that you don't know, or has access to information that you don't have as a consumer. We call this information asymmetry or information scarcity. This situation no longer exists. The banker doesn't know more than you know because the available content and amount of information that's in the system is so overwhelming. Customers may have done hours of research on a particular investment or a particular product before they come in to speak to a banker, and the banker may be unprepared for that research the customer's done. It even happens in private banking today, where the clients will come in and know more about an asset class or a product than the private banker themselves. This is because information asymmetry no longer exists. So here's an illustration. In 2007, on YouTube, we uploaded 7 hours of video every minute. What that means is that in 2007, if you tried to watch all of the content that was on YouTube, you could never do that because every minute that you're watching YouTube, 7 hours of more content is being uploaded onto it. Now that sounds impressive enough, 7 hours every minute. And that was in 2007. Do you know what it is today? Today it's 300 hours of video uploaded to the internet every minute. Now do you know why that is? The thing that's changed is the smartphone. People taking video, these, dealing with this information and content, sharing their moments, sharing videos of their friends, their cats, their kids. This is a different behavior. We never saw this behavior before. This didn't exist in 1980 or 1990 or even 2000. We didn't have this open, collaborative, sharing environment. It's never happened before. It's different. So while we had ATMs in the 80s and 70s and 80s, and while we had internet banking in the 90s, and people said this is going to change banking, we didn't have this level of disruptive behavior change. So today, the world's second most popular search engine is YouTube. Google's number one, but YouTube is number two. Now, the younger generation, the digital natives, my kids, if you have kids, you appreciate this. Their primary search mechanism today is YouTube. They'll use YouTube more than they use Google to search. So when you type in banking into YouTube, what do you find? Do you find information on the banks that you guys work for? Because this is how the next generation of bank customers is finding information about banking. They're asking their friends, they're searching on YouTube, they're looking on Twitter, they're looking on Facebook. This is how they're deciding which bank they should work with. A TV commercial or a billboard or a newspaper ad does not work with this group of customers because they think differently. Here's 3 examples. These are video bloggers. These are kids from around the world who get online onto YouTube and record every week a video or blog about their experiences. And between these 3 individuals, we have Stoy, he's in Estonia. We have Marianne, who was in Mexico City. He's recently moved to New York. And Han, who's in China. These are 3 kids from different parts of the world that between them each get about 1 million views per week on YouTube. Now here's the interesting thing. If you take all of the banks in this room, in fact, if you take all of the banks in the CIS states, all the banks in Europe and in Russia and the CIS states all together, these banks don't get 1 million views on YouTube every year. And these kids are doing it every single week, time and time again. Let me show you one of their videos. Can we have some volume, please?
Мастер дрифта на муравье и просто хороший человек. Ого, да Леонид еще и мастер мистического исчезновения. пальцев играть любит. Ну, сам он круглый, потому что дурак. И лунка как раз под его размер.
This video has already 3.5 million views on YouTube and was only posted a couple of weeks ago. But every single week, this channel, this is хорошо, I don't know how to say it in Russian, this is cool, this is good. This channel every week gets millions of views to the YouTube channel. This is engaging younger kids. This is how they now get their media. This is how they engage. This is how they learn. This is what they talk about. This is what they share. See, this generation is very different to our generation because they want to see this brand. That's what makes it real for them. If they can see it, if they can see it on YouTube, if they can see it on Facebook, and they want to hear a recommendation from their friend. This is what they trust. So you have a branch on the corner, you have a store on the corner. This is completely irrelevant to this next generation of kids who are coming into the banking market. Now in Ukraine, they're going to represent 40 to 50% of the retail banking market within just 5 to 7 years. This is a big shift. And their instinct is different. Let me illustrate it this way. This is a generation who's going to grow up with digital as part of their life. Internet won't be new for them. Mobile telephones, smartphones won't be new for them. Social media will not be new for them. These are just their life. This is how they live their life every day. It's not different. It's not new. We think of it as new. We think of smartphones and tablets and internet as new. These kids don't think of them as new. They think of it as their life. This is different. Do any of you have children, teenagers? Yeah, some nodding. Let me ask you this question. If you want to get in touch with your teenager and they've got a smartphone or a mobile phone, do you have a more chance of getting them to answer the phone when you ring them or if you send them a text message? They don't use the phone to talk on it. They use for text message more than they do for talking on the phone. This is a different behavior. If we start thinking that they are going to behave like we did as an older generation, if we expect them to behave, then we don't understand this fundamental difference. They have grown up in a different world. How are you going to deal with kids who become customers who have grown up with this technology from a very young age? 80% of these Y-Gens have bought a product based on their friend's recommendation. They choose restaurants based on where their friends check in on Foursquare and on Facebook. How are you going to deal with kids like this when they become banking customers? See what's happening? What's she doing? She's trying to interact. Where's the button on the iPad? You see, her instincts are different. She doesn't understand why this newspaper, this magazine, this physical artifact doesn't work like the iPad. And she soon goes tired of it and wants to go back to the iPad. Listen to her reaction. She loves it. This is my friend's daughter. She's now about 4 years old, but by the age of just 12, 13 months, she was already proficient on an iPad, using an iPad. If you say to these kids, I'm sorry, you can't do that, you have to come down the branch and sign a piece of paper, they just don't understand. They just don't get it. It's not their instinct. You might have to train them, about these different things. These kids by 2015, mobile is going to be the most interactive device that they have in respect to banking. They will use the mobile channel more than any other banking channel. This is just 2 or 3 years. Maybe in Ukraine it might be a year later, 2016, but it's certainly already happening. But for the rest of us, already this change of behavior is affecting us now, because now it's so easy to take out our phone and just check our account balance on a banking app that now we don't need to go to the ATM as much. We don't need to visit the bank as much, particularly if we're transferring money. Now we can send money by PayPal or by Facebook. Why do we need to go down the branch and do those sorts of basic transactions? This is changing the way we behave. You might have to teach these kids what these two things had in common. You remember how we used to have to wind back our cassette tapes? Right? Or maybe why you use this to send messages to your friends. This is something our kids don't understand. Kids today, they don't even know where to put a stamp on an envelope. This is not a skill they're used to. Maybe we should have training classes on how to put stamps on envelopes. I've got to help these kids out, right? Or why you had to rewind this before you took it back to the video store. I don't know whether you remember. They used to penalize you if you didn't. Remember? You have to pay a penalty if you didn't rewind the videotape. This is different behavior. And certainly, our kids are not going to understand why we use this for banking. It's not their instinct. It's not their instinct. So no matter how much we like the way we used to do banking, the way we used to use passbooks, the way we used to use branches, the way we used to want to talk to these banking customers, this is not going to be the instinct of the next generation of banking customers. And if their instinct is not to visit the bank branch and not to use a savings book and not to use cash as much as we use cash, if their instinct is not to do that, then the economics of the model fail. We just won't be able to sustain as many bank branches as we have today. By 2016, digital interactions with retail banks in most developed economies will be outnumbered face-to-face to digital 350 to 1. Now, if you think the branch is where the relationship with your customer is, this is where the magic happens, this is where we have to get them in to talk to them, and I'm a digital competitor that is talking to your customer 300 or 400 times more than you are in a physical space, you can't compete. There is no way you can compete. There's no way that 1 or 2 or 3 or maybe 4 visits to a bank branch every year is so special that a digital competitor that does all of this digital stuff really, really well is not going to steal your customer. Now, granted, you can do both. But not many banks will not be able to afford to do both, to do digital and branches very well. Maybe they'll have to choose. You look at some countries of the world where banking infrastructure has been poor, and you might say in cash economies, this is not going to work. Maybe in a place like Ukraine where you have heavy reliance on cash, mobile payments and smartphone banking, it's not really going to change things because cash is so much a part of this economy. And not everyone has a bank account. Well, in Kenya, up until the middle of the last decade, 80% of Kenyans did not have a bank account. And then in 2006, M-Pesa comes along, part of the Safaricom Vodafone business, and they start to use the phone to do mobile payments, mobile remittances. So if I want to send you money, I can take my phone out, I can put in your phone number, how much I'm going to send you, and I can text you the money. Then you can take your phone into another M-Pesa shop somewhere in Kenya and show your balance on your phone. It doesn't have to be a smartphone, just a regular feature phone. I show the balance, and I can withdraw money from the shop using my phone. I can go to an ATM machine and withdraw money from an ATM machine using my phone. This is in Kenya, in sub-Saharan Africa. And this is interesting because 80% of the economy, 80% of the population didn't have a bank account in 2006. Today, half of the population in Kenya uses M-Pesa to send money. Half of the population in Kenya now has a bank account on their mobile phone. But the only technicality is that M-Pesa is a telco, a telephone company, not technically a bank. But this has happened in Kenya. It can certainly happen here in Ukraine. But this is not just about putting internet banking on a mobile phone or putting a debit card in a wallet. There are some fundamental changes here. I wanted to show you this. This is some new technologies come out recently. This is called the Scanadu tricorder. Now you hold this device up to your temple and it transmits information to your iPhone on your physical health. It's like a heart monitor that they have in a hospital. When you go into a hospital and they're measuring your vital signs, this can give you all of that same information on your iPhone or your tablet just by holding this little device up to your temple. It completes a circuit. It takes your pulse from your thumb. It takes your pulse from your temple. It measures that in terms of the circuit that your circulatory system is taking. And it can do all of this instantaneously and feed it to your iPhone. This is amazing technology. What is it going to be like when doctors don't need to see you in their office to diagnose your physical health? This is the sorts of technologies we're seeing now. Or this is the shirt from Under Armour, a company in the United States. This is the E39 shirt. You wear this shirt and you can see it's got a little yellow pad here which sends out data to your iPad or your iPhone. And this pad is inspired by the Iron Man movie. But the shirt has these sensors in it and it measures your heart rate, your calorie burn, all of this information in real time. So a coach can tell which of his players is fitter by them wearing a t-shirt and getting this data sent to the iPad. Incredible technology. What would a health insurance company pay for this type of information when they're making an insurance decision? Our behavior is changing, but it's being augmented by these technologies. So in the future, rather than saying, when you want to borrow money from the bank, you have to come down the bank branch and fill out a form, and maybe, if you're not too risky, maybe, if you're lucky, in 5 days' time, we might tell you if we're going to let you be our customer. This is what the banking system is like today. You have to come in and submit to this process, this event. But in the future, we will know whether you're a safe or risky customer based on your behavior. And it'll be far better quality information for assessing risk and whether or not we want to work with you than filling out an application form. The concept that coming into a branch means less risk for the bank is one that will disappear very quickly. Data will trump. And banking itself is starting to disappear. This is Uber in San Francisco. You take out your phone, you order a taxi on your phone, and the car comes to pick you up, drives you to your destination, and when you exit the car, your account is automatically charged. You don't need any card, no payment device, there's no terminal in the taxi. You just get out of the car and your trip is paid for on your smartphone. There's no swipe, no tap, no physical payment event. And ultimately, this is what's going to happen as a result of this technology. Banking will start to disappear. It will just become embedded in our life. It will make our life easier. Things like Google Glass technology. What's this going to do for the banking industry? You know, things like buying a home. We think about this. When we want to buy a home, banks think, you're not buying a home, you're buying a mortgage. You're not buying a car, you're buying a car loan. You're not going shopping, you're buying a credit card, because these are the products the bank has. But ultimately, a customer doesn't care about the mortgage, they don't care about the car loan, they don't care about the credit card, they want to buy the home, they want to buy a car, they want to go shopping or traveling. So the friction that we have in the process of applying for a mortgage is just friction. It adds absolutely no benefit to the customer. It doesn't make it easier for them to buy a home, it makes it harder. So whenever we have this new technology come into play in the distribution space, it attacks friction. It removes friction. It makes the process simpler. Whether it's buying a record or music, whether it's downloading a movie, whether it's buying a book and downloading that to a Kindle, or whether it's buying a mortgage, this technology will attack friction. And there's a lot of friction in the banking industry, a ton of friction. So maybe you'll go to an airport and you'll get a text message on your phone that says, you're about to go on a holiday. Would you like travel insurance to protect you while you're on the holiday? This is a useful interaction because it's giving me a product when and where I need it. It's not asking me to go to the bank branch to fill out a travel insurance application form. That's not helpful, but this is helpful. Or maybe when you're out looking at a car, maybe in the future your glasses or your smartphone will be able to tell that you're in a car dealership and tell you that you're pre-approved for a car loan and exactly how much it's going to cost. You know, we can do this today with the technology we have today. This is not futuristic. This is data and technology capability we have today. But in the next 5 to 7 years, we're going to see a lot more of this. Or maybe ladies, when you're out shopping for your next pair of shoes. Right? You're out, you're looking at the shoes. Maybe what you really need your phone to tell you is, can I afford to buy those shoes? This is a question we have. Instead of just making these instinctive, impulsive purchases that we do today, which has got us in trouble with our credit cards, in the future, we'll get advice delivered to our phone. Now, we think of banking, and we think the best type of advice is advice you get from a banker when you see them in a bank branch. But you know what? If I'm getting advice like this on my phone every day, a banker in a bank branch can't compete with that sort of advice. This is much better advice because it's going to change my life. It's going to change my habits. It's going to change my wealth. It's going to change my control over my spending. It's going to help me save. This advice is the sort of advice we need to see in banking. Or maybe something like this. You walk into a retailer, you're looking at a brand new flat screen TV, and your phone says to you, well, you know, there's a better deal around the corner, or there's a better deal online at Amazon, and you've got enough money in your savings account to buy this flat screen TV, but your rent is due in a week, and if you buy this flat screen TV, you won't be able to pay your rent. You know, this is information that we're going to start to see banking transform into. Banking is no longer going to be a place you go. It's going to be about the decisions you make every day. And the banking advice that we get will help us every day. And the friction will be removed. The application form, the physical place, anywhere that slows us down as a customer is going to disappear because it doesn't add any value. And the next generation of customers in the mix, they're going to look to their phone for advice rather than a banker. Now, not every bank branch will disappear, but a lot of them will. Because as your banking habits change, banking becomes something you do, not a place you go. And this is really this transformation that we're seeing taking place now. So I thought, guys, that I would use this as sort of a bit of a start to the discussion today. I hope that that's given some context to my thoughts around it.
Thanks a lot, Brett. It's really